the growth of tokenized T-bill products is like precisely because the major stablecoins are not providing any permissionless yield into the ecosystem. And so this growth will continue as people demand more capital efficiency.
Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today I'm joined by Guy Young, Ethena and Sam MacPherson. Spark, guys, welcome.
Good to be here.
Yeah, guys, this is going to be a fun one. We are going to be doing a deep dive on all things DeFi. So we're going to be talking about different sources of yield. We're going to be talking about American DeFi, baby. And, we're also going to be talking about some of the upcoming plans for both Spark and Ethena. So this should be a lot of fun. But before we get into it, or maybe starting from the top here, I actually want to talk about the different sources of yield that exist in DeFi today. And I think that's going to flow nicely into some of the partnership that Ethena and Spark, the partnership between Ethena and Spark today. And Sam, maybe can I kick it over to you? We were talking about kind of these three large sources of yield that exist in DeFi writ large, or that are available for DeFi protocols to tackle. So you kind of just give us an overview of what those three buckets look like.
Yeah, sure. And I'll run over them historically. So originally the yield sources in DeFi, so Maker was one of the first DeFi projects that emerged in 2019. Multi-collateral DAI was launched. And the yield sources at that time were primarily coming from crypto over collateralized native lending. And this is primarily against ETH and Bitcoin. So this is, I think a lot of like OG users are familiar with this. You lock up your ETH into a CDP, and then you could mint DAI, and then you're paying interest on this loan. And this is the source of yield. So this remains today as one of the three main large sources of yield in the space. And then in 2022, we saw the onboarding of real world assets, in particular tokenized treasury bill products, which provided the risk-free rate on chain. This was essential for reducing the amount of capital that was outflowing during the bear market of 2022. Stablecoins were providing no base yield at that point. And so capital was exiting the system to go into treasury bills. And so by tokenizing these treasury bill products, we were able to stem these flows a little bit. And this is the second major source of yield. So T-bills, over collateralized crypto lending. And then the most recent source, so this has been largely in centralized exchanges, like segregated from DeFi. And Ethena was the first project to do this at a large scale, which is to tokenize this funding rate on chain so that people could get access to this who have capital in DeFi. And this bridge did a number of things that were great. So this is another for Maker. It was another yield source that we could tap into, and at a very large scale too. So this is the scale of centralized exchange funding rates is actually far bigger than even DeFi. So this is a huge liquidity sink that we can put our funds into. And then for users of centralized exchanges, this provides some interest rate relief. They're able to leverage more and not be paying as high of fees. So it's a mutually beneficial relationship all around.
And Guy, before I kick it over to you here, Sam, a follow-up question for you is, can you just talk a little bit about the quantum or the amount of yield in each of those three buckets? And, I know there was a pretty large pivot for folks who don't have the full history of Sky at the time Maker, when there was this kind of shift into and this embrace of RWAs. So can you just give us that little bit of the history of Sky and why that decision was made, and then talk about the relative size of each of these different yield buckets?
Yeah. Okay. So going back to, again, the beginning of Maker, the original, so it was always imagined there would be RWAs would be required to be collateral for DAI. Rune from the beginning has been saying this, but in the original launch of DAI, the only collateral actually was ETH. So at the time, there was more demand for leverage than there was for people holding DAI, right up until March 2020, when we had the Black Thursday event. And in that case, the demand for DAI became higher than the amount of demand for leverage on the other side. And so the dollar peg broke upwards. And the only way to bring this back down is to onboard uh, something that's like a higher form of money, basically. So USDC was onboarded to bring the peg back down in line, or else the product would have failed. So this is required. So this is a first sort of look at what is the demand for leverage in DeFi, and from that point onward, the demand for leverage is less than the demand for stablecoins. Stablecoins have far surpassed the amount of demand there than on the other side. So you cannot support a stablecoin and scale it purely based on leverage alone. So what that size is today, it's on the order of like 10 billion ish, 10, 20 billion. And so it's sizable, but it can't cover everything. And this is largely split between uh, Sky, the rebrand of Maker, and Aave. Aave and Sky hold most of the crypto over collateralized lending on chain. Now, the other liquidity sink is T-bills. So this is, well, stable coins originally, and then this was moved to T-bills because this provides the risk-free rate. But it's effectively the same thing. It's ultimately collateralized by T-bills in the back end, and this is scalable to basically infinity compared to hundreds of trillions. Like this is huge amount. So effectively, you can consider T-bills infinite. And then more recently, with the centralized exchange funding rates access, this is more on the order of many tens of billions of dollars. The guy can comment more on the exact scale of this, but yeah, it's much bigger than DeFi.
Yeah, I think Sam's right there. So open interest roughly across like BTC, ETH, and Sol in the market right now is roughly $110 billion. And the interest rate is actually slightly higher than like lending rates that you see within DeFi. So if we're trying to express this as a sort of what's the gross cash flow opportunity or like the amount of revenue that you could possibly fit into a stablecoin using these sources, I think the back of the envelope, in my mind at least, is you've got roughly 10 billion within like DeFi leverage, and that's as Sam pointed out, predominantly captured by Spark and Aave, and that's roughly paying like 8% annualized on 10 billion, so call it like 800 million of gross cash flow. And then within CeFi, you've got 110 billion, which is annualizing roughly in the last year at 18%. So that equates to like $9 billion of revenue in across that entire market. So the CeFi market is almost a whole order of magnitude larger in terms of just the gross cash flow that's produced from demand for leverage. And then I think the other piece is that it's also growing quicker than DeFi. So if you just look at the size of the derivative market relative to market caps, open interest has increased at roughly a ratio of 1.5x to the underlying. And so if BTC doubles over the course of a year, the size of the derivative market actually tripled in that same period of time. And so this is one of those interesting things, which is even though the market's growing, actually like the TAM for capturing the basis within CeFi is growing quicker than the underlying spot assets. Yeah.
That's super interesting. I guess follow-on question to that is, how do you guys expect these sources of yield to change across different market cycles? Like, how has it responded in the past, right? If the derivative right of open interest on sexes is Bitcoin doubles and open interest triples, does it work the other way in reverse? And I guess same for the more DeFi native, like over collateralized lending market. Like, how do you expect those sources of yield to change as market conditions change?
I think what we saw last cycle, I think it was a good indication that we're near the bottom was when we were trying to leverage loop like stablecoins on chain. And I remember like the T-bill rate was actually higher than where you could borrow in DeFi, which I think is just a very, very good sign that you're close to the bottom. I think generally both perp funding rates and DeFi rates in the last cycle did actually dip below where you could sort of achieve holding just straight T-bills. I'm not sure we sort of get quite as extreme in the next bear market. I think we were really living in a pretty unique moment in time in terms of how high risk-free rates were. Just looking on a multi-decade period, that really was one of the highs that we've seen relative to crypto rates in general. Obviously the demand for leverage shrinks when you get into a bear market. But I think even when you look at it like on average during some of the worst years, you still typically tend to get paid slightly higher than risk rates. Yeah.
Yeah, and I can comment on the on-chain. So yeah, historically for Maker, as Guy said, obviously the demand for leverage drops in a bear market and it explodes during a bull market. Like so, makers still able, even in bull market, except for like very peaky moments, makers actually still able to maintain this large excess of cash, and actually targets a 25% cash reserve, which is like fairly high if you look at regular like reserve banking. This is
Right.
like this is a massive number, and we keep it so high precisely because crypto is so like crazy volatile, right? So like people like once the bull is in full swing, like they don't care how much they're paying that much. Like they just want to leverage, and so you really have to start like turning up the rates to when you start running out of liquidity, which will happen during like really peaky moments. But normal steady state sky these days is more like a mix and with like 1/3 T-bills, 1/3 crypto over collateralized lending on chain, and then it's going to move up to about a third. Well, not quite a not quite a third exposure to the basis trade on centralized exchanges. So it's this like nice mix between the three, and you get nice properties of liquidity, pretty good yield, and diversity of collateral.
Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. So, do you guys think it's possible, Guy, I know you were just mentioning that like there's a pretty good bottom indicator last time when funding rates dip below, the cost of borrowing on an exchange dip below the risk-free rate of treasuries. Do you think it's possible to look at any of these sort of indicators around yield to determine where we are in the cycle, like on a longer term basis? I know people love to look at funding rates as kind of almost like an RSI type indicator, right? Which is this is a little bit overbought or oversold at any particular moment in time. But is there a way to kind of more on a macro or secular level look at some of these, I don't know, different indicators of yield to tell sort of where we are on a longer term basis, or what do you think about that?
Yeah, for sure. I think twice in the last couple of years when you've seen funding rates go below treasuries, it was literally within 2 weeks of like the stone cold bottom. So I think it happened as well towards the end of the last summer that we saw. We also had that unwind before Trump came in, and again we saw funding actually average around 4% in those final weeks just before we did bottom then. And then equally, Athena likes to advertise the funding when it's extremely high, and every time that we're sending out a tweet to say it's 50% funding or whatever it is, the market seems to nuke like the day after. I've just sort of anecdotally noticed that as well. So it definitely is an indicator. I mean, for like mathematical reasons, you can't even sustain the market when the funding is that high. It's just like literally you're going to run out of money at some point to sort of afford the financing. And so, yeah, I think it's a very solid indicator, but I'd also just encourage people to at least consider the fact that Athena has sort of changed those dynamics and metrics or frameworks that you had before and after the existence of Athena should be reconsidered, just because it is a pretty large piece of the market right now. And so you might look at the market and not think that it's that overheated compared to the same like heuristics that you had last cycle. But that's also because there's $6 billion of shorts from Athena that make it look less overheated. And if Athena wasn't there, it would be more obvious. And so I think there is a bit of Athena's existence essentially sort of disguises some of the overheating within the market, just because without us, the funding would be that much higher. Yeah.
I guess final question for you guys, just on that middle bucket of real world asset yield, so treasury yield. Obviously, there are different types of stable coins which share yield back to users as well. Like, what do you guys ultimately think is the end state for that? Is it basically just like a steady climb upwards right now? Like, any thoughts just in terms of, I actually don't know the total amount of treasuries that exist on chain. Is it roughly like, I think it's like 20 or 30 billion or something like that? I shouldn't guess publicly on a podcast here, but like any thoughts in terms of like how big that bucket ends up climbing, maybe on like a 1 or 2 year time horizon?
Yeah, I think this trend of seeing the growth of tokenized T-bill products is like precisely because the major stablecoins are not providing any permissionless yield into the ecosystem. And so this growth will continue as people demand more capital efficiency. So yeah, I expect this trend to just continue and even beyond. So T-bills are just the low-hanging fruit. I
Right.
expect RWA growth to move beyond that eventually. Corporate debt, tokenized. Like, I mean, I'm a big believer that everything will just be tokenized. Like, once we get this, so there's this big lift that has to be done to get everybody on chain. But once that happens, like everything's just gonna move over pretty quickly after that. So, yeah, of course, I expect RWAs to continue to grow and to become a huge asset class within DeFi.
Yeah, I maybe have a slightly different opinion here. I think I'm quite bullish on like non-treasury based asset growth going forward. So I think when the rate cycle continues to sort of compress as we go into the next couple of years, I think we will see a bit of a chase for yield at some point, and you might see like tokenized high yield credit funds and those types of things emerge on chain. And I think this is actually a pretty interesting design space actually for hybrid instruments between, you can make something that looks and feels a little bit like a stablecoin, which is say like 80% backed by normal treasuries and then 20% by some sort of high yield credit instrument that sits in the background. And if you think about it, that's kind of what like Tether was doing many years ago when people were worried about them, which was you'd take a little bit of duration risk on a piece of the backing which you are comfortable is not going to get redeemed, and you sort of run a little bit of risk on that side and get paid for that duration risk while you have the rest sitting in something that's a bit more liquid and redeemable. I think we will see some experimentation there, and like the natural catalyst for that is just rates on T-bills coming down. I'm quite bearish though on just tokenized T-bills as just like an attractive product within crypto in general. I think they're useful when you start to put them in useful places. I think one example here can be when you're trading derivatives on exchanges to be able to use it as collateral and sort of get paid on your collateral side. That's a useful piece. But I think most of the growth that you've seen on chain, when it's not sitting within a more useful asset like a USDS stablecoin where it can actually be useful and used for different things, it's kind of just like foundation striking deals with some of these RWA providers to, you scratch my back, I'll scratch yours type thing, and throw in like $20 million, and it sits there on chain. And I'm just not that convinced that that's a market that's got 10x growth left in it. I just don't think people turn up in crypto and think I want to hold something that's paying me 4%. And I think the history of crypto is actually you've got to live on one of the two extremes. You're either like the most liquid and safe stablecoin in the space, or you're like the high yielding, higher risk one. And this sort of like middle ground of like trying to do both at the same time, you kind of don't really have a user base on either side. So I'm generally quite bearish on just the growth of like normal vanilla tokenized treasuries sitting on chain, unless they're used for purposes like collateral or within a stablecoin. Yeah.
I don't know if you have a response to that, Sam, but and God, just to see if I'm digesting that point correctly, is okay. There's like kind of two different categories of stablecoin here, and also there are instruments sort of like USDE here, like USDE in a sense here, or maybe the analogy would be money market funds in TradFi, which is an actual stable asset, right? Which is like a $1 type asset, but you're getting yield on it. And there's room for experimentation in terms of these stablecoin issuers to, maybe take a little bit more duration risk or do something interesting on the fixed income side to juice that yield and then share it back. But ultimately, like, it's more interesting to have a stable instrument as opposed to something like treasuries, which they pay you some sort of yield, but also there's like, capital appreciation or, the value can kind of sell off as well. Is that roughly? What do you think, Sam?
I can comment a little bit. So I think I actually don't necessarily even disagree with what Guy was saying. So I agree that tokenized T-bills as a product of like a user-facing product it will not be that popular because I agree. Like, why would you come on chain right now to hold a T-bill product? It doesn't make any sense really. But as collateral, it makes a lot of sense and so I think the growth will be as products like USDS, which have multi-collateral backing. Again, we like the demand for holding USDS is larger than the capacity that we can put into crypto over collateralized lending. And we could put it into the funding rate, but there are like risk trade-offs and stuff like that. So we want to have a wide variety of sources to sink this deposits into. And so T-bills provide that excess, like basically infinite capacity. And so for that specific use case, I think there will be growth. And then my other, I was more talking about long term. I think right now it's hard to make an argument that yes, RWAs, like I'm struggling to see where exactly they come in, but I believe that just due to the improvements in capital efficiency and economies of scale of the blockchain in general, once we reach this sort of inflection point, RWAs will just, because everything will be, finance will just be on chain. And so it won't be DeFi, TradFi, everything's just going to be on chain because it's much more capital efficient. And so that's when we see a lot of RWAs coming on chain, just because everybody else is playing there. But that's more long term.
Got it. Okay, understood. Okay, I want to talk to you guys a little bit about maybe Sam. I can kick it back to you here, and I want to get a sense of, we talked about these three different sources of yield, right? Maybe some, like 9 billion in revenue that's coming from the CFI side of things and the funding rate, and then roughly a billion or something like that. So maybe call it $10 billion of revenue here that's flowing into DeFi from the combination of over collateralized lending and CFI funding rates. I want to get a sense of like what the different actors are and how that ultimately ends up getting dispersed in between different protocols. And maybe Sam, could you just describe like the Spark liquidity layer and a little bit of the relationship and dynamic in between Ethena and Spark and how you guys are working together here?
Yeah. Okay. So let's go back to last year when we first onboarded Ethena, which was March of 2024. So we were able to get that online pretty quickly. We saw that Ethena, this was a new yield source to us, and at the time that we were going through like a little bit of a bull, whatever you want to call it, moment for a couple months there, and so we wanted to tap into these this funding rates that were like, I think at the time they were like 60%. It was obscene. And so we wanted to deposit into there pretty quickly. However, Ethena was pretty new at the time. I think there was only like about 1 billion in deposits around there when we were originally discussing this. And so we wanted to proceed out of an abundance of caution, just because we want to make sure things are safe for USDS holders. And so we used Morpho lending infrastructure to provide a junior capital buffer in between USDS holders and Ethena. So basically the way this works is there's three parties involved. There's the depositor, which is Spark. There is the issuer, which is Ethena. And then there's this third party, which is people who want leveraged exposure to the Ethena yield. And so they're willing to take this junior piece in exchange for higher yields than even what SUSDE is providing. The downside is, though, that if there's some like depeg or like insolvency or something like that, they're the ones that are going to lose everything first. So this is the trade-off. And so Spark was able to deposit, it went up as high as 650 million. It's still actually hovering at about there, 500, 600 million in exposure. And then there was enough demand for people leveraging in the market to bring it up to that level that we were satisfied with. And then we could gain sort of not quite the SUSDE rate, but slightly below it. And then this continued on over the past year as we gained confidence in the Ethena protocol. We onboarded Pendle PT tokens, which would provide even more boosted yield to Spark in exchange for some duration risk in that PTs are like fixed rates. So in the worst case scenario, if liquidity dries up, you need to hold them to maturity, which means you have to hold these assets, potentially for a few months. So, but the trade-off, we ramped the system up. It's been working like a charm. Spark's been able to get good revenue. Athena's been, we're a good chunk of Ethena deposits. And so this relationship was just great all around. So what's happened more recently, and we announced this a few weeks ago, this is direct depositing into Ethena. So previously we required three parties. Now it is Spark directly swapping USDC for SUSDE. So the protocol is holding it directly on its balance sheet. And then Spark is able to provide the junior capital in the event of shortfall, as opposed to requiring third-party users to do that. So yeah, this is the new integration, and it's going to mean a lot of improvements in capital efficiency. But also, actually, there's an interesting trade-off in that when you are deposited into an on-chain lending market, there's this like 10%, 10-20% in liquidity that's always available that you can pull at any time. But you need to wait. You're dependent on these people who have leveraged up to repay their loans. They usually do because the interest rates go up when you pull liquidity. But there's this like dance you have to do. There's uncertainty with the liquidity that can be reclaimed. Now with
Mm,
these direct deposits, we have much more certainty about when liquidity can come back, and so we can plan for this. So this, we can deposit, several hundreds of millions into SUSDE, and then we know that when we need to withdraw this, even potentially all of it at the same time, there's 7 days, and then we get the USDC liquidity.
mm. So basically, evolution here kind of being, relying on third-party depositors to take some of that risk. That risk is now shifted into Spark. But, the advantage here and what it seems like the synergistic relationship is Ethena is kind of the conduit here for this massive source of yield. And it feels like Sky and Spark as well is sort of this allocator of capital into this source of yield. So Spark and ultimately Sky end up benefiting from getting access to some of that yield, and that should flow into the USDS supply somewhere down the line, I would guess, through higher yields. And then obviously from the perspective of Ethena, there's growth in terms of just USDE in general, right? Is that like roughly kind of the relationship there? Kind of thinking about Sky at the base here as a capital allocator and Ethena as a conduit.
Yeah, exactly.
Yeah.
Nice. All right. Well, very excited. I mean, I don't know, Guy, if you have any comments from your side of things around how you see this relationship growing or anything like that.
No, I think Sam covered most of it there. I think one of the more interesting pieces about this is that they've been extremely intelligent in terms of being able to design different capital structures, which allows them to shift their exposure, duration, liquidity profile as they see fit. So the idea of lending over collateralized is actually very different to holding something that's liquid, where you have exposure to the first loss, but you have different trade-offs in terms of the risk profile and return that you're actually capturing there. And I think one of the more interesting pieces of innovation that fell out the side of this was actually thinking about like fixed versus floating borrowing, which really didn't exist at any reasonable scale before we came together to work together with Pendle pools. So this has just been one of the more interesting ideas this cycle, which is the funding rate is an extremely volatile rate. It can be 60% one week and -5 the next. That's kind of like the range of what you see. And obviously, people just have a different risk preference where they might want to actually lock in something that's a bit more defined over the next, call it like 3 to 6 months. What's interesting about that is that some people can sort of like trade that exposure in something that looks like or is familiar, comparable, I think, to like a fixed to floating swap, which is kind of the piece that Pendle is providing there. And then you can take that asset, which is the PT, which has a fixed rate of return over the maturity period, and then actually collateralize that within Morpho to then borrow and loop and use within DeFi. So I just think that's an incredibly useful, interesting sort of development, and it's really like the beginning of us actually starting to build something that looks a bit more like a real financial system, because actually most of financial markets are debt capital based markets. It's not like around equities, and that's DeFi was kind of all equities before. It was just kind of like leveraging up your shitcoins or like trading your shitcoins in Uniswap. That was kind of it. But I think with SUSDE being brought into the market, you now have this new source of like a fixed income instrument where you can slice and dice up the yield, you can securitize the yield, you can do fixed to floating swaps. And really what that enables is someone like Spark or Sky to be able to look at this and say, where within this capital structure or risk profile do I want to get exposure? And you can sort of like sell that off to different people. So really what we're starting to create here is like the very early innings of what is like the largest market within TradFi. And it was pretty incredible, I think, from my perspective, to just see these different money Legos sort of come together within DeFi and just work seamlessly, because that was actually what kind of interested me about the space back in 2020, that was really the beginning of when we started to see all of this stuff happen with like a synthetics and a curve and all of these things coming together. And it felt like this last year was the first time that we really brought that money Lego thesis in DeFi like back at scale. Yeah.
The first season of Bell Curve that I ever did actually was on fixed rate borrow lend in DeFi. And this was like, there was a protocol back then, I think called Volts or something like that, which was basically, trying to recreate or mimic interest rate swaps in crypto. And I'm not sure what ever ended up happening to that protocol, but yeah, it's a super interesting, the ability to borrow at something that's not variable. And it wasn't even, this was pre Ethena, so you weren't even porting funding rates into DeFi, but it was just like the variable rate that you were paying on Aave or something like that was extremely high and made it very difficult to either do like leveraged type trading, or if you're ever I don't know, like a DAO looking for different sources of funding, right? Or some sort of protocol, right? Like it's all equity financing as well, which is much more expensive than debt financing. So I completely agree with you. I mean, that's like a very necessary building block, and it's cool to see it built out and actually a real world use case right here. So very cool.
Yeah, and at scale. I think that's one of the cool things is that sometimes these things are small science experiments that we do within DeFi, and we go, "Oh, that's like cool and academically interesting," but there's not many things that you do at this type of scale which have that quality as well.
Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today. Okay, I want to switch topics here and discuss a little bit of how you guys view the overall market for stablecoins. So, Guy, you were just mentioning earlier that you see sort of two buckets, which is the deepest, most liquid, most secure type stables, and maybe you would bucket USDT and USDC in that bucket. And then you have stables which return a high amount of yield to users. So maybe Sam, you would bucket USDS, right, in that bucket as well, like returning 12%. I would love to get a sense of how you guys carve up the world of opportunity here for different stables. And Guy, I'm not sure if USD if you would define that as a stable, or like how you just define that product in general. But I also want to get a sense from you guys of, I think one thing that we'll probably see over the course of the next year or 2 or 3 is different entities issuing stablecoins, right? So we had, essentially the first kind of like USDC is almost a fintech issued stablecoin, right? If you consider Coinbase a fintech, their distribution platform is part of what has allowed it to grow so much. But maybe you'll start to see, now that there's a much more broad acceptance of DeFi in the US, platforms like a Robinhood or a BlackRock or JP Morgan or whoever issue stables as well. And I would love to get a sense of, if we were to see a whole bunch of new issuers come into the market, how that would change things. So,
Yeah.
Sorry, I asked like 3 questions in one there, but yeah, how do you carve it up today, and how do you expect it to change in the coming years?
Yeah, sure. So maybe I can start. Yeah. So as you mentioned, USDC and USDT, they're dominant in terms of size and liquidity and all these things, and this represents onshore and offshore banking systems. So USDC being plugged into the US banking system, and then USDT being plugged into the Eurodollar system. And so from those, you then have, so those are the anchor points that connect into the US dollar, which is ultimately issued by the Fed. So as you get further down, these products in themselves are more like, it's like narrow banking basically. So people can deposit in them, and then they're just putting it in like short duration treasury bills, stuff like this, that's like highly liquid. And that's their job. They're only meant to do that. Now we have this next layer, which is on-chain stablecoins, on-chain synthetic dollar, whatever you want to call it. It's kind of, they all kind of rhyme a bit, but subtle differences are important. This is more like the broad-based banking system on-chain. So really, this will represent, stablecoins represent any dollar yield instrument in the on-chain economy, and so this can be anything. Like the collateral composition is what's important here. So for something like USDS, it's a fractional reserve stablecoin. So it intentionally does rehypothecate the assets into higher yielding sources, and attempts to keep this, as I mentioned before, 25% cash reserve, so that it's liquid enough for practical reasons. And USDS has been great in this regard. It has never broken peg with USDC ever, and so we have a great track record there. But we're still able to deliver this pretty good yield on the other side. So you're not going to be able to get the the full yield of whatever happens to be the highest yielding source at the time, but you will get decent exposure to it while maintaining high liquidity. And this is the sort of middle ground that USDS is aiming to be. And so we think this is a very compelling product, especially with crypto over collateralized on-chain lending. Again, has just been through the ringer for 5 years, and there's been very little bad debt, between Aave and Maker. Like this stuff just works, and it provides pretty good exposure to leverage during bull markets. The funding rates are definitely higher, but there's different trade-offs there that need to be made. But on-chain over-collateralized lending is just tried and true, and so we think this as a significant portion of the USDS backing is why we think it's a fairly safe instrument, and why it's scaled to several $billions that are earning yield, and that's getting 12.5% currently. And the protocol is profitable right now. It's not like we're paying this out of a deficit or anything. So like the system works.
So I'm just looking at RWA XYZ here, and I think the total stablecoin value today is around 210 billion. And between Tether or USDT and USDC, I think that's roughly 180 billion of that. So obviously the vast majority of stable supply is concentrated in kind of that first bucket of, the narrow banking stablecoin bucket. Do you guys expect that ratio to stay roughly what it is today? Do you expect it to change over time? Sorry, Guy, I also interrupted you before you're going to jump in there, but do you agree with that sort of characterization of the world? And talk to me about that ratio. Do you see it staying the same, shifting? What do you think?
Yeah, I think we do see a bit of a shift to more interest-bearing type of assets being used for these use cases. I think people do over-index on the story of Tether quite a bit, and I think that they look at the business model as the best business model ever created now, but don't recognize the very unique pieces of history that sort of allowed them to exert the monopoly that they do now. And I don't think it can be recreated going forward. So I think the issue here is that the most liquid pairs on Binance are all USDT denominated. So BTC, USDT, ETH, USDT, and just those pairs on spot and perp trading pairs for Binance generate like north of $10 billion of revenue for Binance every year. Why that's important is that it's an incredible moat for Tether, because it does not matter if you're paying someone 4% on an exchange. If they're trading 10 to 100 to 1,000 times a day, if you're an HFT or a market maker, if you're saving 1 basis point on liquidity whenever you're making that trade and having to use USDT for the most liquid pair, you couldn't care less about 5% a year. You couldn't care less about 10% a year, because it's actually around that liquidity piece to be able to trade in, which is really the piece you're focused in on. And really that is Tether's moat to be able to extract what they can at the moment, because exchanges don't want to uproot their existing business models and actually change the status quo, which is sort of making them so much money as it is. And they know that people don't care about a little bit of yield versus that liquidity point. So the reason I'm giving that context there is that I think every new entrant into the market has to think about this axis in terms of trying to grow. So if we think about the three qualities of what a stablecoin is trying to do, when you're a new startup or a new entrant coming into the market, I'm pretty firmly of the belief that you need to do something that's 10x better than someone who's already there to even like begin to compete. And so with stablecoins, you need to be stable at $1. It's pretty binary on that one. You either are or you aren't, and if you aren't, then no one is ever going to use your product again. The other one is like liquidity and brand. Again, almost impossible to compete with something that's trading $100 billion of volume a day with Tether and USDC. And then the last axis is return. And that's where you see guys like ourselves and Spark come into the market and say, we can actually provide something that looks a little bit different, whether it's the construction and the backing or the way that we're sharing things with users. And that's sort of the angle that you have to push to sort of grow. And so any new entrant into the market, I think, has to think about that final piece that I described there if they're going to be able to compete. And I think the issue here is that a lot of the new fintech Web2 type players are going to come to the market. So PayPal obviously did, and I think you're going to see Revolut, Robinhood, all of these guys. If you're ever going to be trying to push that asset outside of your own sort of like closed ecosystem, I think they're all going to struggle immensely because they don't understand why it is that Tether is actually winning because of those network effects around liquidity. So unless you're going to try and compete in the same way that Spark and Ethena has, I think it's almost impossible to sort of shake up the existing like market structure as you see it now. Yeah.
Okay, I want to get into the Ethena Spark angle here, but before one thing that I was thinking about, or I'd be curious to get your guys' opinion on in general, is exchanges as a form, like a critical form of distribution for stablecoins, especially in the early days. And if you look at USDC versus something like USDT, where those network effects came from is obviously Coinbase and Circle have this partnership, the Center Consortium, and there's some sort of rev split essentially that goes on there. And the distribution that Coinbase had in the early days is part of what allowed USDC to grow an enormous amount. And they're still kind of the dominant stablecoin within like DeFi. Like even if you look at the crazy amount of volume that's come from the Trump coin and like the stable growth on Solana, that's mostly been USDC, not USDT. But also there's a little bit of a challenge now maybe from the USDC perspective, where because other exchanges understand that Coinbase gets revenue from the USDC, then they're less likely to kind of push it on other exchanges, whereas USDT was more of a neutral, right? It wasn't associated with any one exchange in particular, so it allowed it to become the dominant pair on a lot of these offshore exchanges. I mean, do you guys roughly see it the same way? And then does USDT, do you guys know if they share any of these any revenue back to exchanges, or is that a completely closed door?
As far as I know, no, not to anyone.
Yeah, interesting. Wow. Okay, that is a pretty good business then. All right, so talk to me about then, like what is going to be the what's going to be the impetus here for more of these yield-bearing stablecoins winning over the long term? And it is interesting. There's actually a really good interview on a Blockworks podcast called Forward Guidance with this ex central banker called Sir Paul Tucker, and he was describing, this was a couple of years ago, he was describing why there was so much debt issuance in the US around COVID. And he's kind of just describing the demand for yield-bearing money versus non-yield-bearing money. And if you think about treasuries mostly as just yield-bearing money, right? It is, that's essentially what it is. Then there's more demand over time, especially from institutions, for money that bears yield or monetary assets that bear yield as opposed to non-yield-bearing money. So you can kind of look at the relative size of the treasury market versus circulating like M2, and it's very different. So what is the catalyst that we need for yield-bearing money versus non-yield-bearing money to change in crypto? What is it going to take for us to see that ratio change?
Yeah. So I think these are entirely different products in my view, and so they can all coexist. And there's going to be, especially with the yield-bearing version. So the non-yield-bearing version, the narrow bank version, USDT and USDC, those ones you can't do any variation on that really. It's just like you have onshore banking, offshore banking, and that's the difference. And the liquidity mode makes them that they're dominant now, so they're going to retain dominance unless something catastrophic happens. For the on-chain yield-bearing stable coins, this is broad banking. So the collateral composition, even though as we talked about before, there's really only 3 scalable yield sources at this moment. I don't think that's going to be the case forever. And so as we onboard more and more assets, this is going to be highly diverse set of stable coins that are available to users on chain, and as there should be. I think markets are healthier when there's competition, and so having user choice here is very important. And so I think there's just going to be thousands of stable coins tokenizing every single dollar yield instrument that exists. And so this is why Ethena and USDS, these are not, they're both on-chain stablecoin synthetic dollar, similar looking products at face value, but there are many different properties between the two, and we're optimizing for different user segments. And so I expect we're just the start of this space maturing in my view, and that means a huge variety of options available to people.
Yeah, I think I read a roadmap piece a couple of weeks ago which tried to actually segment what are the use cases at the moment for stablecoins or on-chain dollars. I think the 4 different buckets we had were developing world store of value, and I think that the best example here is just Tether existing on Tron at roughly $60 to $70 billion in size. You got the trading crypto collateral use case on CeFi. That's roughly, I think, 120 to 130. And then I think you've got savings tool technology, which is kind of the bucket that Ethena and Spark sit within right now. And then there's payments, which I think is clearly going to be big at some point in time, but is pretty much irrelevant at the moment at its current scale. I think that savings bucket that we're existing in right now honestly has a 5 to 10x in the next couple of years of growth that's coming. And the real reason I think that we haven't seen that grow is that we haven't actually had or haven't like integrated ourselves in the right places to actually just be able to deliver that to normal people in a very simple way. And so if you go into like a Robinhood or a Revolut or whatever it is, none of these like interfaces that might have some sort of tangential touch towards crypto are really plugging into like on-chain sources of return, which you might see with something like an Ethena or a Spark. And I do believe that like most of the use cases that you're seeing now for demand for stables are really like within the crypto ecosystem, like trading on like native exchanges and that kind of stuff. I do think that there's like a big piece of work on like both of our sides, which is actually just trying to plug this in as back-end infrastructure into huge distribution channels that exist already. And that can be like Web2, FinTech. There's a piece that I spoke about Telegram around that side as well. So I really do think it is a piece around distribution at the moment, which is we haven't really got outside of the sort of like degen crypto crowd over the last couple of years for that kind of product. Yeah.
Do you think some of these new issuers, like if we were speculating on like the Revoluts of the world or whatever, so I would guess that they would try, if they were issuing their own stablecoin, it would be more along the lines of Tether or USDC like stablecoins, but correct me if I'm wrong on that assumption. Is that what you guys think as well?
Yeah.
Do you think that mostly they're going to try, like if you had to guess at how this plays out, I could see a world where all of them try to launch their own stablecoin initially, maybe one or two of them end up taking off, most of them don't, and then they just end up integrating other like the USDEs or USDSs of the world. Like, is that roughly how you see it playing out? Or like, do you think everyone's going to try to leverage their own distribution and launch their own successful stable, and then a very small amount of those would work? Would that be the base case?
Yeah, I think that's right. I think people are going to spend a lot of money and time basically just splitting up the market and bifurcating it into hundreds of different like of assets, which actually just makes the net user experience worse. I'm extremely bearish on like anyone coming into the market and trying to like replace crypto native use cases where USDC and USDT already exist. I think there's just no incentive for people to swap out, and that's what you saw with PayPal. Having said that, I think if you're operating in a net new piece of the market, so I think payments here is a very good example where stablecoins just aren't really used for payments in any substantial form right now. But if you do see like a Visa and a PayPal and a MasterCard turn around and say, hey, we're actually going to replace rails where there's actually like TradFi rails at the moment and stablecoins aren't touching it at all, and they sort of like force that to happen, that's clearly an area that they're going to dominate. It's just not going to be in the existing use cases that we find now. So I think it's like perfectly possible that you see one of these payment providers have a stablecoin that's much larger than Tether, but that actually takes them sort of looking at their existing business model and tearing it up and starting anew with something else, because a payments company and a stablecoin business are complete opposite ends of the spectrum. One is like a flow-based business where you're collecting fees per transaction, and the other one is a balance sheet driven business model where you're collecting like a NIM on your stablecoin. So that's actually like the $1 trillion question for like payments, I think, in the next 5 years, which is, are you willing to take that risk to swap between a flows-based business into something that looks like stablecoins, which is not an easy decision to make. Yeah.
Do you think they're going to try it?
I do. Yeah, I think like PayPal is sort of like giving the signal over there. Yeah.
All right, everyone, listen up. Like I said at the top of the episode, Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there is a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today. All right, I want to change topics here a little bit and get your guys' take on this whole American DeFi trend. So we had a Trump coin and Melania coin and whatever else launched this week, but there's also been this broad push towards DeFi renaissance, but also US DeFi renaissance. And there's been early indications from this new political administration in the United States, the Trump administration, that they want to actually incentivize basically tokens to launch in the United States, and there might be some sort of preferential treatment for protocols that are based out of the U.S., et cetera. And historically, I mean, for the last couple of years, we've watched a lot of protocols and dev teams and foundations get pushed outside of the United States, and that's been especially challenging for DeFi protocols. And now it's sort of interesting to watch maybe an enormous amount of incentives get rolled out for DeFi protocols to operate out of the United States. So I would love to get a sense, like, how real do both of you think this is? I mean, anything that you can share in terms of expansion plans into the United States, and like, what does US DeFi really mean? Is that a meme? Is it real? Like, how are you guys thinking about the whole thing?
Yeah, I mean, it's great. So like, I think we've gone through these like phases. Like, first they ignore you, then they laugh at you, then they fight you, and now you win. So I think we've arrived at the now we win phase, which is awesome. And I think it's a testament to the resiliency and market fit of crypto. The fact that we've been able to grow and thrive, even despite the U.S. government trying to do things such as Operation Choke Point 2.0, where they were actively debanking a lot of the crypto, the banks that were dealing with crypto companies. And so this change has just been amazing. And so we're super excited to finally start cooperating more with regulators and make sure this space is safe. Because I think regulation, when it's done right, it can be good. There are lots of scams out there in crypto. And so this is the nature of the permissionless blockchain. And so getting more tools available so that we can grow in a way that actually transforms finance and makes people's lives better. I'm all for that. So like, we want to revolutionize traditional finance, make improvements, and improve people's lives from the status quo. So having the US being more friendly here is going to be great for innovation. And we're actively looking at the US now. We were very much avoiding it before. Now we're looking at getting more involved in the US.
Yeah, I think echoing Sam's comments, I think there's no like immediate move from us to open up. So at the moment, have no US retail users like within Ethena, and I think that's a decision which is going to be slightly slower and more measured if we want to sort of step back from that and change that going forward. I think we are opening up more of an institutional product, which might be able to access accredited investors that sit within the US, but I think that looks very different to like a permissionless and open retail-facing product like you've seen in the past. But yeah, I think I don't really think it's a meme. I think it's very real. Trump sitting there, Trump-associated projects launching things within DeFi, the changes you've seen in the last 48 hours, within the SEC and CFTC. I think these are all just extremely positive like movements, and we're just very excited to start to actually operate in an environment which feels supportive for the first time in many years. Yeah.
What do you guys think about the Trump Memecoin? I'd be curious, just however you want to take that question. And, does that mean, and I guess maybe one more specific part of that is the general take is that this is open season and this means you can do whatever you want. Do you agree with that from your guys' perspective as protocol founders, and any like personal opinions you have on the Trump coin or what your reaction to it was?
Yeah, I've been going through a few. I've been kind of thinking about it for a little bit, how I feel about it exactly. I mean, on the face of it, it's pretty cringe, like what they did there. But this is the nature of permissionless blockchains. Stuff is going to come up that you don't necessarily agree with, but you have to respect people's ability to do it. Now, in this case, I don't know. I'm still kind of debating what exactly this means for everything. It's a pretty mixed bag. So yeah, I don't know. I'm still up in the air a bit.
Yeah, I'm just wondering when I'm doing building a project instead of trading meme coins when I still have my phone moved in the weekend.
Yeah. I think that's what we were all looking at. I was telling you guys before, I think I picked the worst weekend ever to be offline from crypto. So missed generational wealth on this one, but what are you gonna do? I don't know. There's a way that I feel about it as an American. There's a way that I feel about it as a someone who's building a crypto company based out of the United States. And Yeah, I think there are pros and cons basically, but I do think it's a relatively big inflection point for the industry overall, at least U.S. crypto on a 4 to 5 year time horizon here. I think it is definitely meaningful. All right, guys, I know we're kind of starting to wind down here, but I wanted to ask Guy a couple of things that you listed in your most recent piece or upcoming things on the Ethena roadmap. So I know you're working on something that's a little bit more of an institutional wrapper for USDE. So talk to us a little bit about that. What is the impetus for that? How do you actually perform that sort of transformation to make your product more suitable for an institutional audience? And then maybe we can close on Telegram.
Yeah, I think mechanically there's not that much that's going on except for adding like basic permissioning around the token itself. So in the same way, when you're touching one of these tokenized money market funds or treasury bill products, you generally can't send them to any address that you want to. So like BIDL, for just one example here, you need to be operating within like a permissioned ledger that's sort of maintained by Securitize on the other side. And this is just like pretty basic like KYC requirements that you have from institutional players that aren't that used to touching crypto rails. And so really like the vision here is that a product like this, you could argue, is like one of the most natural fitting products for us to actually take as one of the few products that you can export out of crypto into traditional finance. Like a dollar with a return is one of the most basic products on earth, but it kind of appeals to everyone, whether you're an institution, a hedge fund, private credit fund, or like a retail individual in Southeast Asia. It's like that. It really is like a TAM of the world. And all we're trying to do here is just put in the rails where it's extremely easy for them to get access. They don't have to touch crypto at all. So you can just be buying the shares of an SPV that's actually managing a fund, which is essentially just holding a bunch of USD as the underlying. And then that allows them to just be able to deal with fiat directly into the fund, get the exposure that they want when they want it. And I think, yeah, just open up a new product and user base for us going forward. Yeah.
And talk to us a little bit about the expansion into what you're doing with Telegram as well. And I don't know if you saw the news that Telegram is becoming exclusive with the Ton blockchain as their sort of backend, but I don't know if either of you guys have any thoughts or comments on that, like the sort of strategic direction that they're taking there, but then also what the plans are for Athena to integrate into Telegram.
Yeah, I think no particular insight on the Ton news that came out, but I think our high level perspective on this is that it just represents a very interesting distribution channel. So I think we're speaking about this through the entire discussion now, but there's nearly 1 billion people that are using Telegram in some way, and these are often people who aren't interacting on chain or within crypto native apps that you see already. And so for us, it's really just trying to hit both ends of the spectrum. On one side, you've got like TradFi players where you might interface with one entity who's looking to get exposure for multi-billions. And then on the other side, there's retail users who would want, tens or hundreds of dollars of exposure just sitting within in an app that's extremely easy for them to use. So for us here, I think it's just a very interesting net new distribution channel where you can try and create something that feels a little bit more Web 2 and like a neo-banking experience within Telegram itself. And all of it is powered by USD in the back end to sort of provide that infrastructure. And I think it really gets to that point we're making earlier, which is these are useful products, but we haven't been able to deliver them to normal people in a format that they're comfortable with for a long while. And I think this is just one of the steps that we're taking to try and solve for that at the moment with Telegram.
Yeah, and with in terms of distribution for USDS, this is the Spark liquidity layer that we've rolled out recently. Is our multi-chain expansion, which will include things such as Ton. So right now we're rapidly expanding out. Previously, USDS has primarily been on Ethereum, and so the Spark liquidity layer is this liquidity management infrastructure. This is the primary product of Spark that exports stablecoin liquidity cross-chain. So in November of last year, we just deployed on Base. And so users on Base can now swap their USDC, native USDC, into SUSDS and start earning this yield. They're able to do this one-to-one swap at a very large scale because the Spark liquidity layer will move USDC from mainnet over to Base to ensure that there's always enough exit liquidity such that users can feel comfortable getting in and out and getting access to this yield. So we're going to be rolling this out to basically every major chain, Base, Solana, Optimism, Arbitrum, Ton, Barachain, et cetera, et cetera. And then in addition to that, we are able to, on the allocation side, we are able to allocate to other protocols. And this is what we're looking at for distribution moving forward. So, Aave is the largest lending market. And so we're able to deposit USDC and USDS directly into their market through the Spark liquidity layer and start accessing those users on every chain. And similarly, on Base, we're able to deposit USDC into this newly launched Coinbase market and get access to the users within the Coinbase app. And we were able to get there in day one because Spark liquidity layer, we're able to react very quickly. So this is the infrastructure that's powering all of this, including Ethena, including Aave, including Morpho, cross-chain everywhere. We're able to just balance out the liquidity across all chains, maximize the return that Spark generates, and solve liquidity fragmentation in US dollars in DeFi to within the capacity that USDS can hold, which is about $6.5 billion right now.
Awesome. Well, very exciting, guys. And yeah, I know we've got to end it here, but Sam and Guy, really appreciate both you guys coming on here and chatting about all of this. If folks want to find out more about the Spark liquidity layer, the work that you guys are doing together, or USDS, Sky/Ethena separately, like what's the best way to just follow you or get more information or whatever it is?
Yeah, just you can follow us on Twitter, spark.fi, or me, Hexanaut. Yeah, that's probably the best way.
Yeah, and for us, it's Ethena_Labs. We've got all the links on there, which can take you everywhere you need. Yeah.
I've got a question for both of you guys. So neither of your guys' Twitter handles your actual names. What's the story behind Hexanaut and Leptocotic? I've never asked either of you guys. What's the backstory there for the Twitter handles?
Oh my God, I made that so long ago. Honestly, I don't think there's, I think Hexcode, I thought it was a cool name. I just went with it. There's really nothing more elaborate than that.
Yeah, for me, definitely regret making the name because I can never actually explain it on podcasts like this. But it comes from like a stats distribution. So like when the tails are fatter than you're expecting. And it's just like generally, I think the crypto is kind of like funnest when those tails are like fatter than you expect. And that can be on the downside and then the upside as well. So that was like the background for me. Yeah.
Nice. All right. I love it, guys. I appreciate the real alpha right at the end here. So thanks, guys, for coming on. Appreciate you both. We'll have to do it again sometime soon.
Cool.
Thanks for having us.
Okay.